I think there's a massive misunderstanding of what's going on with interest rates. And it's confusing a lot of people who are making these assumptions of a pivot or interest rates are going to head lower. And not when you still have the effects of the lockdown. And in this country, in Canada, the immigration is causing a huge short-term demand. So there's a lot of forces that are causing interest rates. But the most important thing, and this is the benefit of being a historian and a student of the long wave, is that interest rates are on a secular rise. There is no denial that that is the reality. Okay. Yesterday I posted this chart, and it tells you everything. Everything from a long wave perspective. So this is Canada's 5-year yield, and you can see that most of the mortgages, I think that number is still true, are tied or dependent on the 5-year yield. Now, if you notice, the chart is in logarithmic, or maybe you can't, in logarithmic format. So just to give us an idea of the impact of the recent rise in interest rates, and also its secular downtrend. Notice the green lines were the secular fall in interest rates, and that's the monetary wave, which alludes to the falling price of credit, which allows Ponzi finance and credit inflation to flourish, simply because incomes are stagnant and most people look at their cash flow, how much they can carry every month, and not how big the mortgage is. So if interest rates were 20%, there was only so much leverage. So obviously that bottom in 2020 was the secular low in interest rates. Now, if you see, it's following the trend of marking this trend into the next business cycle, right? The regular business cycle, the kitchen business cycle, as it's known in the long wave, it's averages about 4 years, 5 years. So if you take the bottom, you extrapolate 2024. But 2024 is very important in Canada because we have not only a business cycle peak, but we also have a real estate or demographic cycle peak. That's a millennial boom, the Kuznets real estate cycle, as I call it. And something else is workforce growth will actually peak. This is what's different this time. So we have these forces that are going to impact the economy big time in 2024. And that's why I've always said that the recession will occur post-2024. There is nothing to show that that it's occurring this year outside of the leading indicators in the financial cycle. So again, the 4.75%, it's just that at that point in rising interest rates at 4.75% is when the acceleration of the real estate bubble started after 2007. So that's that horizontal yellow line. That's why it's important. It breaks that. There's so much leverage in the system since 2007. As it continues to go higher, it will only force interest rates much lower. Okay, so this is why this chart, there's a big story in here, lots of stories to articulate. Most important thing is that unlike 2008 in Canada, the financial cycle peaked a couple years ago. And that was simply, when I allude to the financial cycles where the leverage could start because interest rates fell, right? And we had interest rates at a secular low, and that bottomed in 2021 and it started rising. So there was the peak, and that's when the leverage peaked. Now we're still, this is just cycles, right? Notice there's a rising real GDP into the future. Even Condrainta's economic winter does not mean a permanent downturn. That's why we allude to economic winters, because there will be an economic spring. Just like the fourth turning has 4 turnings, the long wave has 4 seasons. So this is where we are. And again, next year is going to be the key. If you look at the business cycle and the sentiment, you can see, it's rolled over. We're still growing, albeit slowly. Is a recession? No. There's anxiety. There's denial about what actually is occurring in the economy, but we haven't got to the point of a recession. And when that comes, that's going to be significant because the long wave, the Kuznets cycle, and then the business cycle will all be turning down after 2024. That's why it's an important year. So it's these converging cycles that caused the economic winters in the past. So that's the takeaway. Anyways, I want to keep it short. I hope you find this informative. I'd like keeping them short. It's a great way to educate and understand or help you understand the long wave and where we are in the business cycle and the risks. If you haven't, please subscribe to either the YouTube or Substack account if you want access to the long wave model, which is allocating assets according to where we are in the Kondratiev cycle. Obviously, the one giveaway is that real estate is extremely bearish because it's dependent on the falling price of credit. That is over. Real estate prices will have to adjust accordingly to incomes and inflation. That's the long-term price value of real estate, and that is substantially lower. Anyways, thanks for listening. We will talk soon.